Episode 3, Investing for Beginners, How to Get Started with Confidence. Welcome to the Money Mindset Podcast4. I'm Liam, and in today's episode, we're going to talk about one of the most powerful tools for growing your wealth, investing. If you're new to investing or feel overwhelmed by it, don't worry, you're not alone. In this episode, we'll break down the basics of investing, how to get started with confidence, and common mistakes to avoid. By the end of this episode, you'll have a clearer picture of how to start building wealth through smart investing. So grab a coffee, get comfortable, and let's begin your journey toward financial confidence and success. Section 1. What is investing? Let's start with the basics. What exactly is investing? At its core, investing means putting your money into something with the expectation that it will grow over time. It's about using your money to make more money. Instead of letting your cash sit idle in a savings account, investing allows your money to work for you. When you invest, you're essentially buying an asset, something of value, that you expect will increase in value over time. This could be stocks, bonds, real estate, mutual funds, or even a business. But investing isn't magic, it's a disciplined process built on sound decision-making, patience, and understanding risk. And the earlier you start, the more time your money has to grow through the power of compounding. Section 2. Why should you invest? Now, why should you even care about investing? Why not just save? Here's the thing, while saving money is important, it's not enough to simply store your money in a savings account. The interest rates on savings accounts are usually very low, often less than the inflation rate. That means your money is actually losing value over time. Investing helps you grow your wealth. Investments have the potential to yield higher returns than traditional savings accounts. Beat inflation. By earning returns higher than the inflation rate, you preserve your purchasing power, achieve long-term goals, whether it's buying a home, funding your children's education, or retiring comfortably. Investing helps you reach your financial goals, create passive income. Certain investments, like dividend-paying stocks or rental properties, can generate income without active involvement. Section 3. Common myths that stop people from investing. Let's tackle some of the most common myths and fears that hold people back. I don't have enough money to invest. This is perhaps the biggest myth. With the rise of fractional shares and low-cost investment apps, you can start investing with as little as $5 or $10. Investing is like gambling. While both involve risk, investing is about informed decision-making over time, whereas gambling is based on chance. Successful investors do their homework and focus on long-term trends. I need to be an expert to invest. Absolutely not. While knowledge helps, you don't need to be a Wall Street analyst to invest. There are many beginner-friendly options and tools that simplify the process. The stock market is too risky. Yes, there is risk involved, but there are also ways to manage and reduce that risk. More on this later in the episode. Section 4. The power of compound interest. If there's one concept you absolutely must understand as a beginner investor, it's compound interest.
Albert Einstein allegedly called it the eighth wonder of the world. Whether or not he really said that, it's a powerful force. Compound interest means that you earn interest not just on your original investment, but also on the interest it earns over time. It's like a snowball rolling downhill, starting small but growing rapidly. Let's look at an example. Suppose you invest $1,000 at an annual return of 7%. After 1 year, you'll have $1,070. After 2 years, you're not just earning 7% on the original $1,000, you're earning 7% on $1,070. That extra interest keeps compounding year after year. Over 30 years, your $1,000 could grow to over $7,600 without adding a single extra dollar. That's the magic of compounding. The earlier you start, the more time compound growth has to work for you. Section 5. Understanding risk and return. Every investment carries some level of risk. The general rule is, the higher the potential return, the higher the risk. Here are a few key terms you should know. Risk, the chance that your investment will lose value. Return, the money you earn on your investment. Volatility, the degree of variation in investment prices over time. Some investments, like government bonds, are considered low risk, but they also offer lower returns. Others, like stocks, have higher potential returns but come with more volatility. It's important to understand your personal risk tolerance, how much risk you're willing to take. Are you someone who can sleep soundly at night when the market dips, or do you get anxious when your investments lose value? Knowing this helps you choose investments that align with your comfort level and goals. Section 6, Types of Investments for Beginners. Let's explore some of the most common types of investments and how they work. Stocks. Stocks represent ownership in a company. When you buy a stock, you own a small part of that company. If the company performs well, its stock price may rise, and you may earn dividends. Bonds. Bonds are loans you give to governments or corporations in exchange for interest payments over time. They're generally safer than stocks but offer lower returns. Mutual funds. These are collections of stocks and/or bonds managed by professionals. When you invest in a mutual fund, you're pooling your money with other investors. It's a great way to diversify without picking individual stocks. Exchange-traded funds, ETFs, similar to mutual funds, but traded like stocks. ETFs often have lower fees and are ideal for beginner investors. Real estate, buying property to rent or sell for profit. While this requires more capital and effort, it can generate passive income and long-term appreciation. Index funds. These are funds that track a specific index, like the S&P 500. They're low-cost, diversified, and ideal for long-term growth. Section 7, Setting Your Financial Goals. Before you invest a single dollar, you need to know why you're investing. Ask yourself, what are your short-term goals, next 1 to 3 years? What are your medium-term goals, 3 to 7 years? What are your long-term goals, 7 years? Your investment strategy will vary based on your goals. For example, saving for a down payment in 2 years? Stick with lower-risk investments, planning for retirement in 30 years? You can afford to take more risk for potentially higher returns. Being clear on your goals helps you stay focused and avoid emotional decisions when markets fluctuate. Section 8, Creating an Investment Plan. Now that you understand the basics, it's time to create your investment plan. Think of this as your personal roadmap to building wealth. Here are the key steps. Know your financial situation. Take stock of your current finances. What's your income? Your expenses? How much debt do you have? Do you have an emergency fund? Before investing, make sure you've paid off high-interest debt and saved at least 3 to 6 months of living expenses. Define your investment goals. Be specific. I want to retire at 60 with $1 million is better than I want to invest for retirement. Clear goals help you choose the right investment vehicles. Determine your risk tolerance. Are you conservative, moderate, or aggressive in your approach? Your tolerance for risk should align with your goals and timeline. Choose an investment strategy. Will you be a hands-on investor who researches and buys individual stocks, or would you prefer a passive strategy with index funds and ETFs? Create a diversified portfolio. Don't put all your eggs in one basket. Diversify across asset classes, stocks, bonds, real estate, and even within categories like industries or regions. Set up automatic contributions. One of the best ways to stay consistent is to automate your investing. Set up automatic transfers to your investment account
on a weekly or monthly basis. Section 9, Where to Start Investing, Platforms and Tools. You don't need a stockbroker or financial advisor to begin. Today, it's easier than ever to start investing right from your phone or laptop. Here are some platforms and tools ideal for beginners. Online brokerages. These allow you to buy and sell stocks, ETFs, and more. Examples include Fidelity, Charles Schwab, TD Ameritrade. Robinhood, robo-advisors. These use algorithms to manage your investments based on your goals and risk tolerance. Examples: Betterment, Wealthfront, SoFi Invest. Investment apps. Apps like Acorns, Stash, and Public offer micro-investing and educational content. Great for those just starting out. 401k and IRAs. If you're in the U.S., employer-sponsored retirement accounts like 401k or individual retirement accounts, IRAs, are a great place to begin. Many offer matching contributions and tax advantages. Choose a platform that suits your style, has low fees, and offers educational resources. Section 10, Asset Allocation and Diversification. Let's talk strategy, specifically, asset allocation and diversification. These are two of the most important concepts in risk management. Asset allocation is how you divide your investments among different asset classes, like stocks, bonds, and cash.
Diversification is spreading your investments within each class. For example, buying stocks in different sectors or countries. A well-diversified portfolio might include 60% stocks, domestic and international, 30% bonds, 10% cash or alternative investments. Why is this important? Because not all investments perform the same way at the same time. Diversification reduces your exposure to any single asset's risk and helps stabilize your returns over time. Section 11, Understanding fees and expenses. Fees might seem small, but they can eat into your return significantly over the years. Let's say you invest $100,000 and it grows at 7% annually. If you're paying 2% in fees, you could lose tens of thousands over 30 years. Common types of investment fees include expense ratios, annual fees for mutual funds and ETFs, trading commissions, costs for buying or selling investments, though many platforms now offer commission-free trading. Advisory fees, fees paid to a human or robo-advisor to manage your portfolio. Always look for low-cost funds and platforms. Index funds and ETFs usually have very low fees, often under 0.1%. Section 12, Emotions and Investing. Investing isn't just about numbers, it's also about psychology. Your emotions can become your worst enemy. The market will go up. And it will go down. It always has, and it always will. When stocks drop, beginners often panic and sell. When stocks rise, they might buy. In too late, driven by fear of missing out, the best investors learn to manage their emotions and stick to their plan. Here are a few tips: avoid impulsive decisions, focus on the long term, turn off the noise. Financial media thrives on fear and hype. Don't check your portfolio daily, once a month or quarterly is enough. Staying calm and consistent is key to long-term success. Section 13, Dollar Cost Averaging. Dollar cost averaging, DCA, is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. Let's say you invest $100 every month into an ETF. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this can reduce the impact of market volatility and help build wealth steadily. DCA is especially helpful for beginners because it removes the pressure of trying to time the market. Encourages consistency, builds discipline and long-term habits. Automated investing apps and employer-sponsored plans often use this approach by default. Section 14, Rebalancing your portfolio. As markets move, your asset allocation will shift. For example, if stocks perform well, they might make up a larger portion of your portfolio than planned. That increases your risk. Rebalancing means adjusting your portfolio to maintain your original asset mix. For example, if your target is 60% stocks, 40% bonds, and due to growth, it becomes 75% stocks, 25% bonds, you may want to sell some stocks and buy bonds to return to your target. Rebalancing helps maintain your risk level, lock in gains from high-performing assets, prevent emotional investing. You can rebalance manually or use robo-advisors, which often do it automatically. Section 15, Tax Basics for Investors. Taxes are an important part of investing. The more you understand, the more you can keep in your pocket. Here are the basics. Capital gains tax. When you sell an investment for more than you paid, you owe capital gains tax. Short-term, held less than 1 year, taxed at your ordinary income rate. Long-term, held 1 year, taxed at a lower rate. Dividend taxes. Dividends are often taxable, though qualified dividends may be taxed at lower rates. Tax-advantaged accounts. Use accounts like 401(k)s, IRAs, or Roth IRAs to reduce or defer taxes. Tax loss harvesting. If you sell an investment at a loss, you can use that loss to offset gains and reduce your tax bill. If you're unsure, consult a tax advisor to make sure your investment strategy is tax efficient. Section 16, Mistakes to avoid as a beginner investor. Let's wrap this section
with some common pitfalls that beginner investors fall into. Trying to time the market. Even professional investors struggle to predict short-term market movements. Following the crowd. Just because something is trending doesn't mean it's a good investment. Ignoring fees. High fees can seriously reduce your long-term returns. Investing without goals. You need a clear plan, not just random stock picks. Chasing quick profits. Investing is a marathon, not a sprint. Selling during downturns, stay the course. Market dips are temporary. Not doing research, understand what you're investing in. Don't invest blindly, learn from these mistakes, not by making them, but by avoiding them in the first place. Section 17, Building Wealth Through Long-Term Investing. One of the most effective wealth-building strategies is long-term investing. But what does that actually mean? Long-term investing is holding your investments for many years, often decades, with the goal of achieving steady growth over time. It means ignoring short-term market swings and trusting in the historical upward trajectory of markets. Why long-term investing works: time smooths out volatility. The longer you invest, the less impact short-term downturns have on your overall returns. Compound growth: the longer your money is invested, the more time it has to grow. Tax advantages: holding investments long-term can reduce taxes due to lower capital gains rates, reduce stress. You're
less likely to panic and make poor decisions when you focus on the long run. Investing isn't about hitting home runs, it's about consistently getting on base and letting time do the heavy lifting. Section 18, Realistic Expectations and Historical Returns. Let's talk about realistic expectations. Many new investors think they'll double their money in a year. That's not how investing usually works. Here's a rough breakdown of historical average annual returns. U.S. stock market, S&P 500 7.10% after inflation. Bonds, 2-4%, real estate, 8-10% depending on the market and location, savings accounts/CDs. Section 19, Investing versus Trading. Let's clear up another common confusion. Investing is not the same as trading. Investing is the process of buying and holding assets for the long term to grow wealth. Trading involves buying and selling assets frequently to profit from short-term price changes. Many beginners get lured into trading through flashy apps and YouTube gurus promising fast money. But trading requires deep knowledge, constant monitoring, and high emotional control. And it often results in higher taxes and fees. Statistically, most individual traders lose money over time. If you're serious about building wealth, investing is the better path for most people. Leave trading to the professionals. Section 20, Understanding Investment Accounts. To start investing, you need to open the right kind of account. Here are the main options. Taxable brokerage accounts. These accounts offer flexibility and no contribution limits. However, you'll pay taxes on dividends, interest, and capital gains. Retirement accounts, U.S., 401k, employer-sponsored, contributions reduce taxable income, grows tax-deferred. Roth 401k, funded with after-tax dollars, grows tax-free. IRA, individual retirement account, traditional or Roth versions. These accounts have contribution limits and penalties for early withdrawals. Education accounts, 529 plans, help you save for a child's education tax-free. Custodial accounts, accounts for minors, managed by an adult until the child reaches adulthood. Choosing the right account depends on your goal: retirement, general investing, or education planning. Section 21, Investing for Retirement. Retirement planning is one of the most common reasons people start investing. And it should be, because the earlier you start, the better off you'll be. Let's say you invest $300 per month starting at age 25. Assuming a 7% average return, you'll have around $760,000 by age 65, but if you wait until age 35 to start, you'll only have about $360,000, even if you contribute the same amount. That's the power of time. Key tips for retirement investing: take full advantage of employer 401k matches. It's free money. Choose low cost, diversified funds like target date or index funds. Increase your contributions over time. 1% more every year can make a big difference. Avoid early withdrawals. Penalties and taxes can cost you big. Section 22, Ethical and Sustainable Investing. Many investors today want their money to reflect their values. That's where ESG investing comes in. ESG stands for environmental, how a company affects the planet; social, how it treats employees, communities, and customers; governance, how it's managed and whether it's transparent. You can invest in ESG-focused mutual funds or ETFs that screen for socially responsible companies. While returns can vary, many ESG funds now perform competitively with traditional investments. Ask yourself, do you want your investments to just grow, or also make a difference? Section 23, Tracking your progress. Investing isn't a set it and forget it strategy. You need to track your progress, but without obsessing. Here's how to monitor your investments effectively. Check your portfolio quarterly or semi-annually, not daily. Compare your performance to relevant benchmarks, like the S&P 500. Review your goals annually. Have your timelines or risk tolerance changed? Rebalance if necessary. To maintain your target asset allocation, use apps or platforms like Personal Capital, Mint, Morningstar, your brokerage's dashboard. Stay informed, but avoid overreacting to daily market noise. Section 24, Learning Resources and Continued Education. Investing is a lifelong learning journey. The more you know, the more confident you'll be. Some beginner-friendly resources include books, The Intelligent Investor by Benjamin Graham, A Random Walk Down Wall Street by Burton Malkiel, The Little Book of Common Sense Investing by John Bogle, podcasts, Bigger Pockets Money, The Dave Ramsey Show, Choose FI, websites, Investopedia, Morningstar, NerdWallet, Bogleheads.org, courses, Coursera or Udemy have beginner investing courses. Many brokerages offer free online education. Commit to learning a little bit each week. Over time, your confidence and competence will grow. Section 25, Your First Investment, a Simple Action Plan. So you've learned the basics. Now what? Here's a simple plan to make your first investment. Open an account, choose a low-fee brokerage or robo-advisor, link your bank account, fund your account with a small amount, choose an investment. A broad market ETF like VTI or an S&P 500 index fund is a solid choice. Set a recurring investment, automate contributions, even if it's just $25 per month. Track your progress. Log in occasionally, but don't obsess. Celebrate your start. You've taken a big step toward financial freedom. Remember, your first investment doesn't need to be perfect, it just needs to happen. Section 26, Investing for Different Life Stages. Investing is not one size fits all. Your strategy should evolve as you move through different life stages. Let's break it down. In your 20s and 30s, focus on growth. You have time on your side, so you can take more risks. Invest in stocks or equity-based index funds. Higher risk, higher potential returns. Start early. Even small amounts grow substantially over time. Develop good habits. Automate your investments and increase contributions. As your income grows, in your 40s and 50s, balance growth and safety. Begin to shift some of your portfolio to bonds or stable assets. Maximize retirement contributions. Take advantage of catch-up contributions. Reassess your goals. Are you on track for retirement? If not, adjust your savings rate or timeline. In your 60s and beyond, focus on income and preservation. You'll need assets that provide regular income and are lower in volatility. Rebalance regularly. Protect your wealth by shifting into safer investments. Create a withdrawal plan. Consider the order in which you'll tap into your accounts: traditional IRA, Roth IRA, taxable accounts. Your goals, risk tolerance, and time horizon all evolve. Keep adjusting your plan accordingly. Section 27, Investing in Real Estate. For beginners, real estate is one of the most popular alternatives to traditional stocks and bonds. It can offer rental income, appreciation, tax benefits, diversification, but it's also more hands-on than other forms of investing. Ways to start with real estate: rental properties. Buying property to rent out can generate passive income, but it requires capital, time, and property management skills. REITs, real estate investment trusts. These are companies that own or finance income-producing real estate. You can invest in REITs just like stocks. Real estate crowdfunding. Platforms like Fundrise or Realty Mogul allow you to invest small amounts in commercial real estate projects. Tips: research the market carefully, consider location, property condition, and tenant demand. Make sure you understand all costs, taxes, insurance, maintenance, vacancies. For beginners, REITs are a great low-cost, low-barrier entry point. Section 28, Building Passive Income Through Investing.
One of the best parts of investing is building passive income, money that comes in regularly without you actively working for it. Here are some popular passive income sources: dividend stocks. These companies share a portion of profits with shareholders. Bonds provide fixed interest payments over time. REITs often pay high dividends from rental income. Peer-to-peer lending. You loan money and earn interest. High-yield savings accounts or CDs, not technically investing, but still passive. Income, annuities, insurance products that guarantee income for life or a fixed period. The key is consistency. Reinvest your income when possible to compound your returns. Over time, you can generate enough passive income to supplement or even replace your salary. Section 29. Investing myths debunked. Let's bust a few common myths that hold people back from investing. Myth 1. You need a lot of money to start. Reality. You can begin investing with as little as $1 through micro-investing apps. Myth 2. Investing is gambling. Reality. Investing, when done wisely, is based on long-term growth and sound fundamentals, not luck. Myth 3. The stock market is too risky. Reality. While short-term fluctuations exist, the market has consistently grown over the long run. Myth 4. You need to be a financial expert. Reality. Tools like robo-advisors and index funds make it simple for beginners. Myth 5. I'm too young, or too old, to invest. Reality. The best time to start was yesterday. The second
best time is today, regardless of age. Section 30. Working with a financial advisor, you don't have to go it alone. A good financial advisor can help define your goals, create an investment strategy, offer tax planning and retirement advice, keep you calm during market volatility. Types of advisors: fee-only advisors, paid only by you, not through product commissions. These are generally the most transparent. Commission-based advisors, paid by selling financial products. Be cautious, they may have conflicts of interest. Robo-advisors use algorithms to manage your portfolio at a low cost. When should you consider hiring one? If you're dealing with a large inheritance or major life change, if you're too busy or overwhelmed to manage your finances, if you want peace of mind and professional oversight, make sure they're fiduciaries, meaning they are legally obligated to act in your best interest. Section 31. Investing and inflation. Inflation erodes purchasing power. If your money isn't growing, it's actually losing value over time. Let's say inflation is 3% annually. That means your $100 today will be worth only about $74 in 10 years if it sits in a savings account earning little or no interest. Investing helps protect against inflation by growing your money at a rate that, ideally, outpaces inflation, providing real returns over time through assets like stocks, real estate, or commodities. That's why saving alone is not enough. Investing is essential if you want your money to keep its value and grow. Section 32. Emergency funds and investing. Before investing, make sure you have an emergency fund in place. Why is this important? Investing involves risk. If the market drops, you don't want to be forced to sell at a loss. An emergency fund gives you a financial cushion for unexpected expenses like job loss, car repairs, or medical bills. How much do you need?
Aim for 3 to 6 months of essential expenses in a separate, liquid account like a high-yield savings account. Only invest money you won't need for at least 3 to 5 years. That way, you can ride out the ups and downs of the market. Section 33. Tracking net worth. Net worth is one of the best ways to measure your financial progress. Net worth equals assets, liabilities, assets, what you own, cash, investments, property, etc., liabilities, what you owe, credit card debt, student loans, mortgage, etc. Tracking your net worth over time helps you see how investing contributes to wealth building. Stay motivated, adjust goals as your financial life evolves. There are tools like Mint, INAB, You Need a Budget, and Personal Capital that help track this automatically. Section 34. Investing in yourself. This may sound surprising, but one of the best investments is you. Why? Your ability to earn income is your greatest asset. Gaining new skills can lead to promotions, new careers, or business opportunities. Investing in education, networking, and health leads to long-term financial and personal gains. Consider taking courses or certifications, reading regularly, attending seminars or conferences, building relationships with mentors. The ROI on self-development is often higher than the stock market. Section 35. Taking action. Your next steps. Let's wrap up this part of the episode with a simple action checklist to get you started on your investing journey. Set clear financial goals, build your emergency fund, determine your risk tolerance, open an investment account, choose a diversified investment, like a total market ETF, start with a small amount and automate contributions, commit to learning more each week, track your progress monthly or quarterly, avoid emotional investing decisions, stick with it, you don't have to be perfect. You just have to be consistent. Section 36, Handling Market Volatility and Crashes. At some point, the market will drop. It's not an if, it's a when. So how should beginners handle market downturns? First, understand this truth: market volatility is normal. In fact, downturns are a feature, not a flaw, of the investing system. Historically, the U.S. stock market experiences a 10% correction every 1 to 2 years, a 20% bear market every 3 to 5 years, occasional crashes of 30 to 50%, like in 2008 or 2020. What should you do during a crash?
Stay calm, don't panic sell. Selling during a downturn locks in losses. Stick to your plan. Your asset allocation is designed to weather storms. Buy the dip. If you're still in accumulation mode, downturns are opportunities to buy investments on sale. Remember your time horizon. If you're investing for retirement 20 years away, a bad year is just noise. The people who build wealth aren't the ones who avoid crashes, they're the ones who stay invested through them. Section 37, Investing. Psychology, your biggest asset or liability. Investing success is as much about mindset as it is about math. Even the best portfolio can't protect you from fear and greed. Common behavioral mistakes to avoid: timing the market. Nobody can predict the highs and lows consistently. Chasing trends. By the time you hear about a hot stock or crypto, it may be too late. Fearing volatility. It feels uncomfortable, but it's part of the process. Overconfidence. Thinking you can beat the market
usually leads to riskier bets. Develop the mindset of a long-term investor. Stay focused on your goals, not daily headlines. Trust your process, even when it's boring. Keep emotions in check. Your future self will thank you. Section 38, Tax-efficient investing. Want to keep more of what you earn? Then you need to understand the basics of tax-efficient investing. Tips for minimizing taxes: use tax-advantaged accounts first. 401k, Roth IRA, and HSAs all offer tax benefits. Hold investments long-term. You'll pay lower capital gains tax on investments held over a year. Place the right investments in the right accounts: high dividend or high interest investments in tax-deferred accounts, index funds or ETFs in taxable accounts. Tax loss harvesting: selling losing investments to offset gains and reduce your tax bill. Avoid unnecessary trades. Every sale can trigger a taxable event. It's not just about growing your money, it's also about keeping more of it. Section
39, Diversifying across assets and sectors. We've talked a lot about diversification, but let's go deeper. Diversification isn't just about holding multiple stocks. It's about spreading your investments across different asset classes and sectors so your portfolio can handle shocks. Examples of asset classes: stocks, U.S. and international; bonds, real estate; commodities, like gold, cash. Examples of sectors: technology, healthcare, energy, financials, consumer goods. If tech stocks crash but healthcare performs well, a diversified portfolio helps you avoid big losses. Don't put all your eggs in one basket, even if it's a great basket. Section 40, How to research investments as a beginner. Learning how to evaluate an investment can be intimidating, but it gets easier with practice. Here's what to look for when researching. For individual stocks: company earnings and revenue growth, debt levels and profitability, market position and competitive edge, valuation metrics like P/E ratio, management team and long-term vision. For mutual funds or ETFs, expense ratio, lower is better, fund performance history, holdings and asset allocation, fund manager's track record. Tools to use: Yahoo Finance, Morningstar, Seeking Alpha, your brokerage's research section. Remember, simpler is often better. You don't need to be Warren Buffett to choose a low-cost index fund and start investing wisely.
Section 41, Creating a personal investment philosophy. Every great investor has a philosophy, a guiding set of principles that informs their strategy. Ask yourself, do I believe in active management or passive investing? What level of risk am I comfortable with? How often will I review or adjust my portfolio? What am I ultimately investing for? Your philosophy helps you stay disciplined when others are panicking or chasing trends. Example philosophies: I invest in globally diversified index funds for long-term growth and keep a 60-40 stock-bond split. I use a simple 3-fund portfolio, contribute monthly, and rebalance once a year. Write down your philosophy. When markets get rough, read it again. Section 42, Common Questions from Beginners. Let's take a moment to answer some common beginner questions. Question: what if I invest and lose everything? A. If you invest in diversified assets like index funds, it's extremely unlikely. Markets have always recovered from downturns historically. Question: should I pay off debt before investing? A. It depends. High-interest debt, like credit cards, should be paid off first. But you can often invest and pay down low-interest debt like student loans simultaneously. Question: what if I start too late? A. It's never too late. While earlier is better, even people in their 40s and 50s can catch up with smart investing and consistent contributions. Question: do I need to check the stock market every day? A. Absolutely not. In fact, that's a great way to stress yourself out. Once a quarter is often enough for most long-term investors. Section 43, Red Flags and Scams to Avoid. Unfortunately, the investing world isn't immune to scams. Here's what to watch out for. Red flags: promises of guaranteed high returns, pressure to invest quickly, lack of transparency about risks, unknown or unlicensed advisors, complex products you don't understand, common scams, Ponzi schemes. Pump and dump stock tips, unregulated crypto schemes, fake investment apps or websites. If it sounds too good to be true, it probably is. Stick to reputable platforms and always do your research. Section 44, Rebalancing, keeping your portfolio on track. As markets move, your portfolio can drift from your original allocation. That's where rebalancing comes in. Example: let's say your original plan was 70% stocks and 30% bonds. After a strong year in stocks, your portfolio shifts to 80-20.
That's more risk than you planned for. How to rebalance: sell some of the overperforming asset, stocks, buy more of the underperforming asset, bonds. Do this once or twice a year. Rebalancing helps maintain your risk level, encourage buying low and selling high, keep you disciplined and strategy focused. You can also automate rebalancing if you use a robo-advisor or certain brokerages.
Section 45, Final Thoughts, The Power of Starting Today. Let's end with this. The best time to start investing was yesterday. The second best time is today. You don't need a perfect strategy. You don't need a huge amount of money. You don't need to understand everything, you just need to start small. Stay consistent. Learn as you go. That's how wealth is built. Think of investing not as a get-rich-quick scheme, but as a long-term commitment to your future freedom. Conclusion: that's a wrap for today's episode of the Money Mindset Podcast4. I hope this deep dive into investing for beginners has given you the clarity and confidence to take your first step, or your next step, on your investing journey. Remember, you don't need to be rich to start investing. But you do need to start investing to become rich, financially, yes, but also rich in opportunities, options, and freedom. If you enjoyed today's episode, please subscribe, leave a review, and share it with a friend who needs to hear this message. And don't forget to follow us on social media for weekly tips, tools, and inspiration. Until next time, I'm Liam, and this is the Money Mindset Podcast4. Keep growing, keep investing, and keep believing in your financial future.